Today we have another coaching call. You guys love these because you guys can sit there in your car, or if you're watching this on the YouTube channel, you can armchair quarterback other people's personal financial sheets and see how you measure up against Jasmine here. If you guys want to do a free coaching call and get yourself put on this hot seat, please reach out. I know other listeners really appreciate this, you guys doing this, because I think it is really helpful. Because we try and get past all the surface level stuff, and it really is personal finance with a infinite amount of variables in here. If you guys are new to the group, get access to the member site where we have a log of all these coaching calls conveniently separated in terms of net worth. So you see where you fall in and you start watching the videos with the people higher net worth so you can kind of see how the road unfolds. So today, Jasmine has been with us. I think we met in 2000, right after the pandemic, right? 2021.
Yeah.
I keep pretty good notes on this stuff. We met because you were poking around, maybe we shouldn't say the name, a certain turnkey provider's website. We had our intro call, which you guys
Right.
can still do out there. And what the heck are you doing buying turnkey rentals? You're an accredited investor, for goodness sake. But then I paused and I pondered and I was like, well, I bought a lot of those turnkey rentals, so we all make mistakes. Give us a little snapshot on where you're at.
Cool. Thanks, Lane. Yeah, it's been an interesting and fun the last 2 years, getting to know you and your team as well, and just doing real estate while balancing a full-time job. I'm Jasmine. For those of you who are listening or watching, let's see. Lynn said my husband and I own a small portfolio of 8 rental homes, and not all of them are turnkeys, some of them, and one here in California, which, yeah, I don't even know if you can call that rental because it's crazy. Even though we bought it in 2009, at the time, it's like unknowingly we became landlord. And then fast forward 10 years later, we purchased a whole bunch more in a matter of, I don't know, a year or two. It's like learning through a fire hose, if you will, everything. And currently, both my husband and I each have our own full-time job while managing the portfolio as well.
You guys are one of the more sophisticated investors because you started from buying rental properties. And I talk about this in my new book, where there are, within investor world, there are like kind of four levels of investors. The first level is a lot of our parents, if they own rental properties, or the old school landlords, these are the guys who will
Mhm.
buy properties where the rent values make absolutely no sense. They buy properties where they live. And maybe I'm picking on a bunch of people, but mom and dad bought a property in LA for 20 grand and now it's worth 2 million. The next level is kind of aware how to underwrite properties. If you guys still want to get the analyzer, you can download that for free. But the second level is you're starting to become a little bit more aware of numbers and not just buying real estate to buy real estate, which is probably still a good strategy. But then after you bought that California property, you guys stepped into that second and third rung, which the third rung is you become a little bit more sophisticated and start to understand that, hey, there's other places outside of the old state of
Right.
California and that could provide cash flow. Imagine that. And then you go to that fourth rung, which is you start to scale up and you buy more. And this is all before you start to go accredited investor status and then going to the LP syndication world, which I think you're making that transition. A lot of the example today is unwinding that rental property portfolio, which is why I always tell people if they need to buy rental properties because their net worth is still low, don't buy so many of them and be like Lane and Jasmine here because it's a pain to get rid of those things.
I hope that's not the case when we need to get rid of, but who
Yeah, well, we
knows?
talked through that
Yeah.
strategy too, because unloading properties, essentially, I think where this call is going to be going is you've redeploying capital, but where do you get that capital first?
Exactly.
And essentially
Yeah.
becomes like a witch hunt for the lowest returning ROE
Mhm.
dollars first. Just to recap this financial sheet on the left, on the top side is this is the balance sheet. This is the important part to me, in my opinion, for most of us passive investors. The big thing is the net worth, $2.5 million. And that is broken up by all the assets minus the liabilities in the rental properties and the homestead. And on the bottom is more of the income sheet. And this is the velocity and where you're heading. As Jasmine mentioned, both working professionals, high pay professionals. And the thing I key in on here, and if you can help me verify this, you guys save about 3,500 a month. So about 40 grand a year is what you guys
roughly.
put to savings. How is the salary split between you and your spouse? Is it pretty even or?
Oh, I would say definitely my husband would be 65, if not 70, depending on the month, if he has to go into work on call. So it's mostly his. I make enough to pay California taxes, Lane. That's it.
Yeah. And you guys have children,
We do.
right?
We have two boys, school
Okay.
age.
So are both you and your spouse working at full capacity, or is one kind of taking over more of the homestead duties?
No, it's pretty fair even in a household in a sense. I work from home, my husband works outside of the home. So I take on more of those like drop off, pick up the kids type of thing because it's just more convenient for me and easier for me to do that. But other than that, the homestead, home duty distributed quite evenly.
Okay.
Yeah.
So just for other people out there, the big things that really move like budgets are like daycare, and those variables are like if you have grandparents or staying at home and going to 50% work or not working. Those are
hmm
typically the big common things I'll see. But
hmm
nevertheless, it all comes out at the end. They're saving about 40 grand a year.
Hopefully
That
a little bit more after the little one is out of private school for his preschool and kinder. That's close to $1,000 a month too.
Yeah,
Yep.
and you can take advantage of that government subsidized daycare.
Yeah, he's going to be
Yeah,
going to public school starting in
yeah.
first grade.
It's not the best, but damn, is it a good
Yeah.
deal in terms
Yeah,
of
which is,
money.
yeah, it depends on how the kid learn. You can still be really good at a public school if you're studious and good student.
Yeah, exactly. So just say this numbers here is what I key in on and just compare yourself with others. Just say
hmm
don't do that, but whatever. Silently do. And it's always good to compare yourself with your right peer group. And so
Uh,
I'm comparing yourself within our investor group of income working professionals that aren't boneheads with their money and just blow it all, like probably most of the people on your street. But yeah, I would say you guys are right about at maybe a little bit less than par, I would
mhm.
say.
Okay.
Is there any capacity to bump your guys' income up, or have you guys found a nice little sweet spot in terms of quality of life and job demands, or maybe talk to us a little bit about that picture? I'm
And
just
then,
trying to find if there's capacity here
yeah.
to really kick it in the butt income wise for the next 5 years. Because
Mhm.
you're in that stage of you're going to need a lot of ordinary income as you're trying to build your net worth. But that
Mhm.
said, your guys' net worth is a lot higher than most of the people at your guys' age with much
Yeah.
higher savings rate. Probably because you started investing back in 2009. Go figure.
The first home in California, and now it's appreciates like crazy for that
Yeah.
one. But yeah, to answer your question is it's a very interesting question, Lane, because that's something that my husband and I talk about almost all the time. It's on a weekly basis because I'm one of the where I get bored with the day-to-day mundane. Even 2 years into a portfolio, I'm like, what's next? What else can we do in the realm of real estate? Can I am always looking to your point, earn more money, but it's not from a place of desperation in a way, if you will. To answer your question, yes, there's that capacity. My husband he can easily pick up, I don't know, another per diem and whatnot. And I can do another side gig. But going back to the second part that you said, with two school age children who are very active in so many different sports, we find what we have right now, it's a perfect happy medium at the moment. So that's
Okay.
why there hasn't been a need or a desire to increase the monthly salary.
Okay. And I wanted to hear it for you from you first before I verify that you are on the right path. Like I
Okay.
would at first I would say, yeah, your net cash flow is a little bit lower. Like most people
Mhm.
have your guys' occupations, they're typically able to save 50, maybe 70,000.
We spend a lot.
Yeah.
You can
But
say that we have a lifestyle, which is probably not ideal when you try to scale up a portfolio,
yeah.
but that's where the balance comes in.
But at the end of the day, the score, the important score,
Mm,
maybe that the all, maybe not the all important score, but the score of net worth, you're a lot
mm,
higher than most of these investors coming in. If I would have guessed, and I always like to guess on these types of things, I would have guessed your guys' net worth was right around 1.4. But then I look at it as 2.5, and I'm like a head scratcher. Either you got some kind of inheritance or you guys have been investing for over a decade, and it's the latter. You've been investing for
mm.
over a decade, so you're ahead of the curve on this one, which is really the more important thing. I would actually say that you guys are probably ahead of the curve. What is your guys' expectation of leaving the day job, or is it a step down thing where maybe you go part-time in the next few years and then your husband goes part-time in 5? Like, what's the working plan for you guys now?
Yeah, the working plan is we both, the lucky thing for us is we both really enjoy what we do. I don't think my husband would like to stop working anytime soon, even part-time, because he always says, knock on wood, the job has become easy for him now. Not to say that it's not hard and someday being in the ER, but he really enjoys the work. And then for me, I want to cut down to part-time and the same token, my kids are in school during the day. So if I cut down to part-time, I'm afraid I might be too bored. But then I'm like, maybe I won't be bored because then I'll put all my energy into real estate and managing the portfolio instead of having the PMs manage them or something like that. So I would say in the next 5 years, I don't anticipate either one of us cut down to part-time anytime soon.
Yeah.
So
So
that's
what I'm hearing is, if anything, you dislike your job more, although that not very much. So therefore, you'd be the candidate to.
I wouldn't say that I dislike my job. I enjoy my job because of the flexibility for work-life balance. The only reason is because I make way less than my husband. So then it would financially would make sense for me to cut down to part-time if we want to, and not for my husband.
Got it. Yeah. So at some point, you do pull back a little bit, but I think what's
Mhm.
really going to be the trigger for that is if you really want to stay at home and spend more time with the kids in the future. Your kids are older than mine. So I don't know how all of that works. I
Yeah,
don't.
they're 6 and 12, so they're in school all day. So and then I get off work at 3. So literally I have the whole day with them. So it's like when they're in school, I might as well work and earn some money. And when they're home, I'm available.
Yeah. And
Mm.
I'm not speaking on from experience on this, but from a lot of investors, you seem to be in this like track where as kids are in school, the only time we can go on crazy vacations and blow a lot of money is 3 times a year
You're
anyway.
right, though. You're right.
I'm gonna just
Yes.
keep making a boatload of money at my day job.
You're not wrong there, Lane.
Yeah. And it's a very common strategy for the next 10 years. So
I see. Yeah.
because it's one of those things like if you can't get over that hump, if your net worth isn't 3.5, 4 million,
Mm.
and you can go full passive and just totally quit the day job, then you might as well just find this nice happy median where you're at.
Exactly. Yeah. I like where your head is at.
And I think it sounds to me that you've accepted it. Some investors, they always have that itch. They always feel uncomfortable and they always got to be doing something. And I think for you, I feel like you've a sense of calmness that you know that you're on the right track, and you are, right?
Thank you for that confirmation.
But we can always do better, right?
That's
That's what your parents
exactly.
say. You
That's
can
not to
always do
say,
better,
yeah, exactly.
right?
I'm thankful, I'm content, but that doesn't mean that we have to stop here. And that's one of the reasons why you're coaching me today, because
Yeah.
show me the way.
My, my parents are horrible coaches. Just said try harder. And that's what we're gonna do. We're gonna go look for the lazy equity that's in your portfolio.
I don't know if I did a
So
good job filling this out, Lane. I'm sorry. It's
yeah, you didn't do a very
oh,
good job filling
okay.
this out. So this page is useless. So we're gonna go look at this asset. So this assets section, right? So just roughly, and I'll type it in here on the side. Out of this 2.5 million, where is all that located? Let's start with the primary residence. How much
Mm.
equity is in there? Your mortgage
Oh, gosh,
minus
I
the
would
home
say,
value.
yeah. Oh, yeah. Let me know when you're done. Sorry, I started talking.
Oh, go ahead. I'll copy what you say.
So, what was the first question for the primary?
Your primary residence.
What do we need to know? The
How
equity
much
versus.
deployable equity do you have in there?
I would say what's 1.1 minus 500? So 700,000.
Call it 600.
Yeah, let's just be conservative, do 600.
Okay, so there's another $2 million we need to find. So what is in your retirement
Mine
account?
alone,
Yeah, and then your spouse's. We'll separate
two, I
them.
think mine is 250. That's the last time I checked, might have gone down by now. And then for my husband, I think it's 5 or 550. I just put 500.
Okay. So that's 1.3. So we're still missing about 1.1, 1.2. Where's all that hidden? So you got some rentals, right?
Yeah, I think there might be more in different retirements. We have so many little, our goal is to consolidate like different
Yeah.
IRAs and different retirement
Okay.
at work and all that. But
Let's stay high level, and if we have time, we can dig into those individual ones. But
mhm,
I got 500 and then you've got 250. Should I bump these up
mhm.
a little bit then?
I would probably more so for my husband.
Okay, we'll do that. And then so how much equity is in these rental properties
Gosh,
here?
that would be hard for me to know. See, I'm terrible. I haven't even calculated this
So
just
you
yet.
got like you put 1.1 million. There's just three properties here. So 1.1 million in terms of market
What?
value, but your president balance is 800. So you got like 300 of equity in these three properties. Does that sound about right?
No, there should be seven of them. I don't know why it has three on there. And then the one in San Diego would make it eight.
Oh, okay. Okay. Oh, I thought this was your
Sorry.
primary residence, so I got to include this one too then.
Did I put the rental in there for San Diego? Sorry, I filled that out a
Okay.
while ago.
So you got 2.5 million of market value and you subtract 1.3. So there's about a million of equity there. And I think that's it. I think we found everything. Yeah.
That's probably the gist of it. Yeah, all the small little accounts here and there probably don't count.
So this is, I'll switch screens here. This is what I use on a lot of coaching calls. We'll go in a little bit more in depth for you because we have a little bit more time. But
Okay.
this is, I think everybody should come up with this kind of loose plan here. This is the deployment plan. And as
Mm,
you can see, it's separated by the years go by. It's a multi-year plan. And the sources of the funds. This is just my opinion. First, it comes from your heart, sweat, and tears and your annual savings. So for you guys, that's 40 grand, right?
okay.
40 grand, 40 grand, 40 grand, 40 grand. Next comes some cash, but you guys are probably pretty good, sophisticated investors and keep very little cash. What do you guys have for your emergency savings?
Right now we have, what is it, 46? I
Okay.
would say 50. Yeah.
And that's probably a lot higher than what most people have or need. Most people, I would say, let's just to float your credit card bills.
I want to have it for at least a year. So 12 months will be 120 grand, but that's
I mean,
just dead
I think
money.
50 grand what you have is good for you guys because you have so many of these rental properties, which are big, variable. Most people don't have rental properties, remember? So
Oh,
it's
yeah,
just
right.
the
Okay.
job. So that's why I say 15, maybe 20 grand. But I think where
Gotcha.
you're at, but
Okay.
we won't deploy any of the cash. It'll just stay in there. Do you
Okay.
guys have infinite banking? Have you guys been contributing
No, I
to
keep
that?
hearing you talk about it. I even listened to your episode about infinite banking, but we never took action on it.
Okay, we can talk about that too, because it
Mm,
for you guys it probably makes sense. Everybody should probably do it once they get above $1 million net worth in
okay.
some facet. The key is just starting small and just increase it from there. But that's and it's not like you put money in infinite banking. You put money in infinite banking and you take the money right back out and invest it. So it's not like one or the other. It's
Mhm.
an and type of strategy.
Gotcha.
But theoretically, the home equity is laziest equity that you have in your primary residence. So I would say go after that first. And if I'm looking back at your sheet here, you said you had $600,000 of equity just in your primary residence. So I'd probably say just to spread it out, 300, 300.
Gotcha.
You can do all 600 in 1 year, but
Mm.
I'm just showing you how you can spread it out.
Can I ask a question on that, the lazy home equity? Because we were one of the lucky ones in getting our current interest rate. I think it's like 2.9 or something like that. And don't know if I'm able to convince is not the right word, but get an agreement with my husband to say, hey, let's take out more money at I don't know, 6 point something, 6.3 today. What are
Yeah,
your thoughts on that?
yeah, that's a very much like mindset thing. It's
Mhm.
really the traditional investment mentality. As
Mhm.
long as you can make a higher return than the
Right,
7%, you do it all
right,
day.
right.
Really what I found that is just your peer group. Hard to get out of that mindset when you're
Yeah,
stuck around other people who think normally. The cash flow doesn't start right away, especially in
yeah,
value add projects, right? And that's where you're making that leap of faith and you're paying your debt
right.
service every month. This is what the banks do, right? The banks play the arbitrage game, and that's what
Yeah,
sophisticated investors do. But to be true, it's just isn't comfortable. If not, we know what's going to happen, right? You're just going to get what everybody else gets. But
true.
of course, in everything that there's risk, right? So if you can go into investments such as preferred equity, very secure, or what some other people will do is say you take 500,000, take $1 million, right? 10%, that's 70 grand of debt payments. And they just take 100 grand of extra distributions or extra loan proceeds out and they just stick it in the bank and they just have it there to last a couple of years. After 3 to 6 months of when the cash flow starts to flow, they're probably like, all right, that was stupid. I don't need to put on the training wheels. I know how to ride a bike,
Yeah.
right? But it's a mindset thing. I'm a little bit, give a little bit tough love, but
No, I like it.
I
It's a good reminder.
think it's just getting around other investors. Let's separate that's financial education. Like I tell my spouse this all the time. Our kid can be an idiot in academically, but as long as they know that they need to play this arbitrage game and they can safely invest in things that will give
Yeah,
them that higher return, which is through your network and your community, then you can do so much better, especially when your parents gift you $1 million or $2 million when they die. And it's all about financial education, not really about academic education. And this is exactly what we're talking about here.
yeah. That's what we're trying to teach our 12-year-old to the 6-year-old. He doesn't know yet, but the 12-year-old, we slowly giving him an account to start investing and just teaching him. At one point, we actually had him do the underwriting for our properties to purchase. That was a fun process to teach him.
Yeah.
But at
And
least
and
he knows.
and you wanted to record this video to maybe show them one day.
One day,
And
right?
one day, this is exactly the thing. This is cool, right? Mom and
Yeah,
dad
totally.
stepped out of their freaking comfort zone
Very
and
true,
did
Lane. I've
something
never done anything
different.
like this. Yes.
And they knew what made logical sense. Nobody else did it. They stopped following what all the sheeple did out there and they tried it out. And yeah, when the
Yeah.
kid watches this 5, 10 years down the road, they're like, geez, mom, even I knew that when I was playing that stupid board game with you when you're 12,
Oh
right?
my gosh, cash flow. We
Yeah.
surprisingly though, our 12-year-old likes playing cash flow, the
Yeah,
game.
the game is cool, right?
The
Because you
game
on the
is really
board,
cool. Yes.
you have the cash flow spaces you need to fill up. So it's very
Mhm.
visual.
And to your point, Lynn, the funny thing is that I wouldn't say every time, but most of the times that we play as a family, my 12-year-old won. And I wonder if it's like that clean slate going in, look at an investment opportunity, or it's like you don't know what you don't know. The first time I was like, oh, beginner's luck, you won. And then he kept winning. And I'm like, that's interesting. Versus the two grown up who have, compared to him, better knowledge in investment and real estate. But somehow he tend to make these decisions that benefited him in the game.
Here's the proud parent moment when the younger kid tells the older kid, hey, even though they're paying debt service on
Yeah.
their money, go after that small deal that only makes you this much. Just have a little patience, wait for the
Mhm.
big deal to come, even though you're pressed on these debt service payments. That's a proud parenting moment right there.
Very true, very true.
I don't know if college is really the right place for that person, but
You know what? You're not wrong. I've been telling my 12-year-old too, I said the expectation is you don't have to go to college right after high school.
yeah,
So
yeah,
not setting that expectation of going to college.
yeah. But if they want to have a lot of fun, college is the way to
Yeah.
go.
Or just travel the world. You can still have fun and learn something. Probably more
Exactly.
valuable.
That's a kind of a personal battle, and I get it. You gotta just like say, look. So like yourself, like you guys have bought rental properties outside your home location. This isn't the first time where you've gotten outside your comfort zone. It's the same thing.
Mhm.
Back what worked for you then. I don't know what it was. Maybe like for me, it was like, let me just try one Birmingham rental out. I don't know if
Mhm.
that was your mental like way to trick yourself, but maybe apply the same strategy to this. So maybe instead
Mhm.
of doing 300,000 out of the home equity, just do 100
That's
at
a good point.
100 at 7%. Well, that's 7 grand a year. That's chump change to you guys per year. Actually, that's only 600 something dollars interest payments every month.
Yeah. So, Lane, for the deployment plan, if I may ask the question, I guess we're talking the how of it, like taking out the money from home equity, but where at our level and based on what on our Excel is
Okay.
still
Yeah,
in.
yeah. To jump the gun,
Oh,
this
sorry.
money, this deployment plan is meant to go into more higher yielding investments,
Okay.
right? You're already an accredited investor who passed $1 million net worth. To me, the way to go is more on the passive side, especially if you guys are still working your day jobs and to gain that diversification of breaking up your portfolio more and more. Because right now there's a big issue with so much equity in that San Diego property, the primary
Mhm.
residence, and all these rental properties. In the beginning, you didn't have too much equity in there, but now you do, and it's prudent to break it apart and
Mhm.
get into you seem to be doing a good job of you got your Missouri stuff, your Missis I'd get the heck out of Mississippi. That's probably one of the
I know I heard
worst.
you on one of the
Yeah,
podcasts
that and
with
Louisiana. They're
insurance.
just horrible states.
Yeah, you
But
know what? Yeah, the insurance this year, man, it had gone up a lot. And one
yeah,
of our homes, not to get sidetracked from our main conversation here, but one of our home went from non-FEMA flood zone to now FEMA flood zone based on all the crazy weather they've had in the past year. So now I'm paying extra, what is it, $820 a year on
geez.
flood insurance.
Yeah. You've done a pretty good job geographic diversification, breaking the money up to in
I
from
agree.
different asset to asset. I
And
think
yeah.
you're already aware of that, and that's where the idea of going into special purpose vehicles, single asset
Mhm.
deals, or blended funds, and just continue down that path. And yeah, unfortunately, right now the elephant in the room are interest rates are very high right now
Mhm.
for the value add real estate play isn't working because when you're in value add, you need to hold on to the asset for
Yeah.
years. Therefore, the interest rates really impact it a lot. Personally, I don't really need the cash flow today. I think you
Mhm.
guys are in the same position, much like
Mhm.
many investors. So you might as well go for the ultimate value add, which is ground up development. If you have that uncomfortableness of paying your 7% debt service on your HELOC, which I think you're seeing my way. It's going to take you time to get over that mental
Right.
hump, but maybe that's where you go and go throw it into T-bills or JEPI, make
Mhm.
5% there, thing to get that cash flow going, at least to beat the arbitrage of that money not doing anything. Of
Right.
course, 7% is a high hurdle rate to go into
Mhm.
T-bills at 4%, but
Yeah.
you could probably get some positive arbitrage with JEPI or some P500 in the ETF. But then you take on the market risks, but
Right. And the
nobody has
tax
a
is
crystal.
also different with passive versus that.
Though your portfolio from the stocks, T-bills, that's going to be ordinary income,
Mhm.
portfolio income. But I think that's a very common question people get is what about the taxes?
Mm.
It's not really about the taxes, just make freaking better returns. Like,
Maybe you'll
oh,
offset with the
it's
loss
like
in portfolio of real estate. Yeah.
big picture here. You're not making anything, dude. Why are you going to complain if you're going to pay 10 or 20% of that on taxes? You're still making a heck of a lot more than you are
Yeah,
now.
good
And
point.
that's this name of the game, right? And you know this. Wealth
Mm.
building, the way we do it, is not a get rich quick scheme. It's
Right.
very slow. And you need to play the game of inches on every single investment. But
Yeah.
right now there are gaps. Like the home equity is not doing anything. The
Yeah.
qualified retirement plan money is not doing anything. Some of your rentals may be too much equity in there. You need to get it moved around. Now, we're
Yeah.
in the mode of cleaning things up at this point. There are some
Yep.
inefficiencies. Now, once
Agreed.
you've done that, which could probably take you another year or two to do it, then we start to talk about tax efficiencies
Yeah.
there. At
Mm.
that point, your cash will probably triple. You probably won't care.
Yeah, that's a good point too. Can I ask you a question real quick on scaling the portfolio?
Yeah.
So right now we have eight, and might be a counterintuitive question, and you might say, no, don't buy anymore. Should we buy more rentals, or should we reserve that money and diversify into, like you said, infinite banking, other options?
Infinite banking is, you should do it either way.
Okay.
It's an and, right? Because you load money into infinite banking, or the way we do it, accredited investor banking, because you can just do it all in 1 year. You don't
Mm.
have to sign up for a multi-year plan. You throw it in there, and next week you take the money right back out. You take a loan from yourself, you put it into your rental properties or your syndication deals.
Okay.
So that one's kind of it. You should do either way. But let
I
me
see.
ask you the question. You've had how many rentals? Like 7 rentals in like more of the turnkey
Yeah, out
red
of state and
states.
one
And you
here in
have the
California.
one San Diego rental. Luckily, you haven't found one of those litigious professional tenants. You've had these for quite some time.
The one in California since 2009, but all the one out of states I've just started in 2020 or
Okay.
2021, so
Okay.
not too long ago. Yeah.
All right. So here's the big question. How many evictions have you had from those other 7 rentals?
None so far, knock on wood.
Okay. Come back when you've had 3 of them, and one
I'm
of
jinxing.
them, one of them is like a 10, $15,000 repair bill.
Oh
And you
gosh,
just can't
yeah,
get this. You just go through a dry spell. You just can't get a tenant in there because it's all sunshine and rainbows now.
makes
But
sense.
the Las Vegas line is, or at least from my track record, you will have evictions. We know that one out of
Mhm.
3 of them will be disastrous. Why are you doing this in the first place? So
Yeah.
you can either take that and make changes, or I was always a learn by do it person. So maybe
Mhm,
you have to
mhm.
learn it and go through it. Or maybe you're a gambler, you want to see 4 evictions and say,
No,
tell me I
I
was
don't think
wrong.
that's me. I don't think that's me. Yeah. I also, I'm similar to you. I learn by doing, and then when the experience knocked me in the face, and I'm like, okay, I get it now.
Yeah. You got
Right
two
now.
boys, right? Two.
Yes.
If you had 5 boys, chances
Gosh.
are one of them is going to go to jail at some point in
Thanks,
their
Glenn.
guaranteed wager, right? Kind
Mm.
of same thing. It's bound to happen with that many rentals.
Yeah. We've spent, I think, on one of the properties that we got in Arkansas, surprisingly, is our newer, or if not newest, amongst our portfolio. And that's the ones that we spent boatload of money on because we bought it as a, what was it, bankruptcy from the seller. And the house was just a wreck after the tenant moved in. Yeah, we've spent a good amount on that one.
Yeah.
But
It if anything, you might make some more money doing that, right? You probably will make more money doing that, but is that
mm,
where you want to be spending your time? There is a
you know
loss
what?
in
You're
time.
right. Yes,
And
yes.
as a person who is at $2.5 million net worth, I maybe if you're at 1.4, I'd say, yeah, if you want to get a little scrappy there, go buy some rentals, do a little rehab. But I would say no way at 2.5 mil. It's like you going back to college and getting another degree at this point.
No, thank
Uh,
you. No, not at
yeah,
this. I
yeah,
see what you're saying. Yeah. I think it's one of the things that my husband and I talk about also is our comfort zone and our willingness to take risk. Circling back to the conversation that we start out with is the quote unquote lifestyle that we have now. How comfortable are we in taking the next risk to then take the home equity out and do all this different diversify of investments? And you're right. I think it's a matter of mindset
yeah.
because, yeah.
In this particular thing of buying more rentals or
Mhm.
getting rid of them, it's all your peer group too.
Yeah,
We've
yeah,
got like
very
over
true.
100 people in the family office mastermind group. I can't really think of anybody buying more rentals. Everybody's trying to dump their
Okay.
crappy rental properties. And I
All
don't
right,
know
that's
if
good to know.
that's maybe just because I did it myself and that was the direction I did and they're just following, but take it for what it is as the data set. Sometimes you want to follow the crowd, and sometimes you don't. Maybe you just want to stay around the sophisticated crowd and follow what they do. But we always joke in that group. Who wants to? I always tell them, well, hey, just make a little PDF on your little crappy rental. We'll put it up on the free Facebook group. for
Who
people
wants to take it?
for some
I think,
sucker to buy it.
yeah. So, Lane, I wouldn't call it a problem, but the conundrum that my husband and I have is come to think about what I said earlier, we're willing to take risk. The hard part right now is not knowing how or where to go or where to invest next or what to do next. So, like having some sense of direction in terms of, yeah, not investing in more physical real estate, but where do we put our money?
Yeah, and that's where as I have my consulting hat on right now, right? Very aware that I'm like a syndicator and I have another hat. I'm always very apprehensive of saying where for you to put your money in. I'm very forthcoming in saying where the money comes from,
Mm,
but I just want to try and keep myself out of trouble. So I'll just speak from my own personal experience. I'm putting my money in equity at this point in the market
mm,
cycle. And
mhm.
when development deals that come up that make a lot of sense that I personally control, then that's where I'm going to put more, make some better returns in that.
Gotcha.
And that's just slowly what I'm going to be doing or what I have been
Mhm.
doing
Okay.
over the past year. Because the value
Gotcha. Yeah,
add
that makes sense.
multifamily plays just don't work. They just mathematically don't work at 7%. The prices
Yeah,
need to come down because there's
way
still
down.
price discovery in the
Mhm.
markets. And as an operator myself, I'm realizing that a lot of the newer operators, and we were there at one time, start with the multifamily value add space because it's a lower dollar amount and there's less competition getting there. And then you need less expertise to do it. We just see a lot of new operators coming into the space and just bidding properties up. And we want to try and get out of that space and swim upstream. That's
Mhm.
why we're continue down the road of development,
Mhm.
because it's just a
Mhm.
lot less competitive space. You
Mhm.
can't do as many of them. That's just, we just feel like it's a safer way for us to go as an investor and operator.
And Lynn, let me ask you this question with the investment direction that where you're going. Do we have to be in the mastermind group that you have in order to join?
No, no, you guys are in the investor club, which is free. The main thing is all investors are vetted, and that's why we do that onboarding call just to
Mm,
see that there's alignment of views. And we've been a lot more selective these past couple of years, got to a point where we've got, I think, 800 plus investors, more than enough that a good portion of the investors, it's more of a point of getting more of a cohesive investor group that kind of sees the same way, the one that understands that right now there is no cash flow because, like you mentioned, insurance, just one line item in many your P&L sheet has gone up. Things are
right,
more
right.
expensive. Why the heck is that? That's your fault. Like
Mhm.
that's a people we don't want investing. We want investors who understand inflation went up 10%
Right,
for the last couple of years.
right.
That's why things are a little bit more expensive. And the price of the property will be rewarded at the end. You just have to be patient.
Patient. Yep. Yep.
But we don't want those emotional investors that are living off ramen noodles and counting their debt service payments by the penny as it continues to go up.
Mhm.
Just not a sophisticated investor. The key is just having that relationship both ways, right? You want to have a
Right,
relationship with the sponsor that you're working with, but so do
right.
we.
Yeah.
I think we are a lot more transparent than most people, and maybe that's to a fault and creates a lot more emails and communications. It is what it is. We treat people how we like to be treated.
Exactly.
Yeah.
Yeah, yeah. I think in this day and age with virtual and AI and all that stuff, I think what you and your team are doing in terms of just over communicate, it add that extra human touch. There's
Yeah.
nothing wrong with that. Yeah.
But it's
Trust.
critical and it's really cool. We disrupt the industry because there's a lot of these good, high quality commercial assets that are untouchable by the regular guy or gal.
Very true.
And by pulling our money together, we're able to get access to these assets that the big REITs are able to get. But then the
Mm,
REITs and the traditional investments, they pile in a lot of those Wall Street fees and bloat in there.
yeah.
But if not, the only other thing is buying retail investment properties, so single family homes, which is now you're
Mm,
competing with all the unsophisticated investors out there, and it's a pain in the butt to manage.
yeah. That's one of the things where my husband and I talk about too is Eventually, when I cut down to part-time, I would want to manage a portfolio because the PM costs and everything is like that extra headache and that lack of control.
Yeah. Come back to me when you've had 6 evictions and at least one or two
Earlier, it was
big
4 or 3
headaches.
eviction.
Yeah. I'm padding my bet here and getting a little more steady state because
Oh
I've
my
seen
goodness.
people,
Yeah,
people have come, I've been doing this a
I'm
long
sure.
time. People come back to me and they're like, I had 3 evictions, nothing happened. All right, go away.
Yeah.
What's your net worth? Half a mil? All right, come back when it's triple that. But
I'm pretty realistic about it. It's part of me, I know I'm not supposed to send out this negative energy to the universe and whatnot, but I just know and hear enough of it that the longer I stay and have this portfolio, the more things gonna happen. So
yeah,
I'm just anticipating.
all of it, that's the old school mentality, right? Do your
Mhm.
own property management in-house, but look at us as an operating group. We don't want to create our own property management company.
Mm,
Why should
Yeah.
you?
Yeah.
And again, it comes down to your peer group, right? Like I think I would probably highly suggest for somebody like yourself with a net
Mhm.
worth of over 2 million in the family office group, you're
Yeah.
not going to regret it. It's more
Yeah.
about the relationships at this point. You've taken it as far as you could all by yourself.
Yeah, I agree. That's a fair
But
statement.
yeah, getting around the debt mindset thing, and
Mhm.
then where do you place your money for? Because I don't want to say where to put your money, because then you'll be upset with me, and I value relationships.
Yeah, I would never do that. I appreciate what you said.
But at the very least, just take a default investment, put it into the S&P 500 ETF.
Mhm.
At this point, it's not really what you're investing in. I said you can invest in some kind of default investment, or some of your money, a good amount of it is making nothing right now. And that's the big thing at this
Yeah,
point.
true. Yes.
So I guess going back to the home equity, that's got to go first. Qualify retirement plan money, this 700 and 200. So on this one for your spouses, is this from a previous employer or is it currently with them now?
No, this is just all from one employer. They have really good matching program, and then this is also combined his IRA that he's been managing. But mine is in an IRA, and I have been trying to deploy that one way or another too. I don't want to keep it in the IRA.
Okay, split this up. So that this first one is with the current company he's with or old
Yes,
company? Okay.
current.
So how would you split this 700 up between the two?
I would say 150 is in the IRA, and then the other 550 should be, or 500 should be in the, yeah, there we go.
Okay. So this IRA is this thing you can't touch it
Right.
because he's with his current employer. So how about yours?
Mine is all 250 in an IRA right now.
Okay, you don't have any company sponsored plan.
No, I decided not to with this one because their plan sucked.
Yeah, good
I didn't really care
way
for
to
it.
follow your gut because you are right. So the good thing there is unlike company sponsored plan, he's stuck. Unless he can pull off an in-service transaction, which I've
He
seen
looked
maybe.
into that and it wasn't, yeah,
Yeah, it's like
I
only
forgot.
10% chance of happening,
Something like that.
more than
Yeah,
likely.
yeah.
But you have more than enough to play with it here.
I agree. I agree. That's why I
So
wanted to ask you that question. I'm like, where do we put our money next, Elaine? I
so
promise I won't get mad at you.
I'm gonna be careful not to tell you where to put it, but I'm gonna tell you where to pull it from. So that's this here because it's non-company sponsored and it
Mm.
just seems to be the obvious choice. The
I
thing
know. Yeah, I
here
know.
is there's tax
Thank you.
implications when you take it out. Where
Mm.
approximately is your guys' adjusted gross income nowadays?
Gosh, I know it's tax season, but we always defer our tax until October. I think last year was 270, might have been 280.
That's a surprise to me, but then again, you have rental
Yeah.
properties, right? That's why it's so low. So
Yeah, we
you
did.
have some room here to
Ah,
increase it. So you probably could take out an extra 100 grand
I
out of
see
it
what you're
every
saying.
year following. So see, now we're really starting to sharpshoot this thing. We're getting it more personalized. So because you've got some freeboard, which
Mm.
is an engineering term in terms of draining and sewage, but freeboard in
Excellent.
your AGI, you have some room to put it up there. You can take out 100 grand every year and just hit there. You could do a lot more, but I'm just giving you more
Mhm.
important thing is you're understanding why these numbers are going here. You can throw it up 100 grand plus if you wanted to and pay a little more taxes. basically what you're doing is you're leaking it out slowly here.
Right,
Some
right.
investors,
That makes
they're
sense.
already in the highest tax bracket, 400, and it's kind of maybe a qualified retirement plan where they can self-direct it, like a solo 401k might make sense, so they can invest in real estate
Mhm.
too. But you don't have that problem. You can reasonably take out 100 grand without your taxes exploding on you.
But are you talking about that being the employer sponsored? Because the IRA, when I take out 100 grand,
It's not Roth, right? None of that is
a
Roth.
portion of it is Roth.
Oh,
The majority is in traditional. Yes.
okay. Taking out the traditional one. You guys may want to keep the Roth in there, but I'm getting too technical for podcasts. But
Okay.
if it's less than 100 grand of Roth, just leave it as Roth.
Okay.
And I'm saying that because your guys' net worth is already 2.5. If it was under 1.5, I might have you guys take that Roth out and pull the goalie.
Hmm.
You gotta grow your net worth if you're under
Hmm.
1.5 at this point in the
Hmm.
game. You guys have a healthy net worth. So we don't need to be super efficient. Let's just leave the Roth where it's at. It's already Roth. 10 years, 15 years, you'd be glad you kept it. But that's the technical thing.
Yeah.
Some people who don't understand anything I'm talking about will say, hey, oh, you told them to take the Roth out. I told them if their net worth was really low because they need the investment capital to get
Yeah.
unbroke. But like I said, you guys are generally better than most people at this stage of the game. Therefore, leave your Roth where it's at. And such a small amount anyway, like I
Hmm.
said.
Yeah.
But your IRA is it pre-tax? Yeah. So you're gonna have
In
to pay
traditional.
taxes on it when you get it out. So that's why I put the hundreds here. But look at
Gotcha.
this. If you add this up, this is like deploying
Yeah.
450 every year. That's a big task in itself. And
Yeah.
that's it, it's good enough. And then we hadn't even gotten to let's go back to spreadsheet. Your rentals. The rentals is where I would probably go last because it's making money. It may
Mhm.
not best return on equity. From that point, we have to drill into each individual property. We're gonna wrap this up here in about a few minutes, but
Oh,
I
right.
would sell the San Diego property first,
You would.
and then slowly unravel these. I would put them up on the website and just sell it
Put it in a
slowly at
PDF on Facebook.
yeah, and I would put it on not my website or Facebook group,
Oh
but
my gosh. I know. I'm just kidding.
the other one, because there's a lot of stupid, unsophisticated investors born every day, and one of them will buy it. It goes off the greater fools theory that there's always a greater fool coming down the road.
Oh,
You can put it on a price on there, slightly
yeah.
higher than you think market value, despite what their broker tells you, because they want action, they want the property to
Mm-hmm.
transact. But you're patient. You're not desperate to sell this stuff. Just put it up there and see what happens, and don't go after any counter offers. Hold your ground
Right.
until the San Diego property has sold, or you've burned through that 450 in terms you've already deployed it out. You need more investment capital. And this is a
Okay.
game of deploy, push, sell assets. None of these properties, I think you have enough equity to make a refinance work.
No,
Not at
you're
these
right.
rates.
Yeah. It's too soon from when
It's
we
just a
bought it.
name of the game and just slowly
Hmm.
exiting them as you need the investment capital.
Okay. So it sounds like, to sum it up, kind of action to take, or my understanding, it's work on the deployment plan. And
Yeah.
then the
What
next step. Oh, go ahead.
this is a big one. I don't want to not touch this. What'd you buy this property for? The San Diego one?
In the twos or mid twos.
250?
Yeah, something like that.
Oh,
Probably
geez.
240 something. Yeah, it's ridiculous. Back 208, 209, it's like when that market
And then they did rehab on
crashed.
it?
We did rehab on it, but it wasn't. I don't know why I put 6. I might have combined here, laying between a
Okay.
primary and that. I don't know.
Well,
I
to
may have told
determine your
wrong.
basis, which is what you buy it
Yeah.
for, plus the receipts that you can come up with for
Hmm.
rehab. But you're looking at a huge capital gain on this thing, and it ain't gonna get any better. What I would do before I sell this property, I would make sure you have enough passive losses from investing, say that 450 that we just mentioned,
But yeah, I
offset
don't
this
know if I
huge
will.
capital gain.
I don't know if I will. Yeah, that's the only thing.
Yeah.
Is this something where the 1031 can go in and do?
I have enough money. People
No?
won't do 1031s unless you're bringing in like a million or $2 million. And then,
Gotcha.
but think about it. In 3 to 5 years, when the deal exits, you're already screwed again. Break it up now so you don't have to worry about these 1031 problems.
All right, some work to be done there. Some
Yeah, some work
thinking.
to be done there, but you have 450,000 to invest. prior to even thinking about this. What I would do is invest the 450, get as much passive losses as you can, sell this in the beginning of next year or the beginning of next year. So you have the entire year to accumulate passive losses, the
Gotcha.
proceeds of
Okay.
this.
Okay.
And you pay taxes, but I think you'll be pleasantly surprised by how much suspended passive losses you get, and then how much you're able to extinguish this capital gain and depreciation recapture. I mean, we just got one of our K1s back. You invested 100 grand, people got like $105,000 in first year losses alone.
Mm.
There's another one that got 3x, but we're not talking about that one. That's the outlier. They invested 100 grand, got like 300,000. That's crazy.
What?
It is
Yeah.
what it is.
Yeah. Interesting. Okay.
But yeah, it's a mess here, but it's a good
It
thing. You
is.
know, at
Yeah,
least you
it
have
is.
money and things to play around with.
But this
But
been very helpful.
hopefully I outlined like the path, right? It's simple when you break it down. Keep working your guys' day job. Just
Mhm.
work the deployment plan. Take the HELOC half now, half later. Take the tech. Just take the whole 600. Deploy it this year. Nothing's
Mhm.
stopping you from making money. And then 100 grand out of the QOP every year to take your AG up right up to that 340,000 number. And then the other fun tax nuance here is this selling the San Diego problem. You're gonna have a big capital gain there, but hopefully because you've deployed so much, you've gotten passive losses from there. That's why it's important to estimate passive losses from this, how much you estimate. Then you can account for this big capital gain and offset it as best as you can. And then you're breaking it all up is what you're doing. You don't have to worry about this 1031 construct, which isn't going to go away unless you break up your portfolio how it is. And then all at the same time in parallel, you're selling off the little individual rental properties, getting rid of the headaches, the legal liability, and run your money through the infinite banking.
Mm,
You know,
I
like the 600 grand that you have from your HELOC, throw it all into infinite
put
banking
it
and then
in the, yeah,
take it right back out and invest in what you were going to invest anyway.
I see.
Yeah.
Look into further
Yeah,
into that.
the accredited investor banking is prime for you guys because you have so much capital right now. You're liquidity rich right now because you have a HELOC. Where the normal traditional infinite banking is like they want you to do 100,000 every year for 6 years. You guys don't want to do that. You want to just throw it all in 1 year, boom,
All at once.
and no more
Gotcha.
commitments after that.
One and done.
Yeah, one and done.
Okay.
Takes the
Yeah, that makes
guesswork out
sense.
of planning ahead in the future.
Yeah.
Yeah, thanks for doing
Eye-opening.
this. Hopefully the kids will watch this one day and now they know why they
Right.
fly first class all the time.
Heck no, that's not in the will.
If you don't fly first class, they will. I will.
No,
Anyway,
I don't know. All right.
thanks everybody for listening. If you guys want to sign up for one of these, let us know. And yeah, share it with your friends.
Yeah.